Good afternoon and welcome to the first edition of the LPEA Training Academy. It is our pleasure to host you today and to kickstart our first module, which will focus on venture capital with 3 dedicated courses until Wednesday. Indeed, we will meet each day from 1 p.m. to 2:30 and learn from hands-on specialists and successful experts. All our sessions will be interactive and allow you to react also and to ask questions via the chat functionality during the session or rather at the end within the dedicated Q&A part. Alternatively, you can also turn on your video, raise your hand, unmute your mic and then ask a question. We are proud to welcome therefore Jérôme Vitamer, former chairman of the LPEA, active ExCom member of our association, and last but not least, co-founder and managing partner of Expon Capital, global venture capital firm from Europe and located in Luxembourg. Jérôme has been active both as investor and entrepreneur in the tech, telecom and internet space and will share with us more insights on the VC fund dynamics, including strategies, portfolio diversification, co-investment and many other important features. Without further ado, please welcome Jérôme Vitamer. Jérôme, the screen is yours.
Thank you, Stéphane. Hello, everyone. Very happy to be with you for the next 1.5 hours to talk about one of my favorite topics, venture capital. So just as a small reminder of what Stéphane told you, this session is meant to be interactive and I like it very much to be like this. So don't be afraid to ask a question. There's no stupid questions, only a really bad teacher, if I may say so, not explaining well some subjects. So we may use sometimes a little bit of jargon. Please don't hesitate to ask your question. And for the LPEA team, just in case I don't see questions, because I will probably not be able to go in the chat box while speaking at the same time, please just interrupt me to tell me if there is something that I need to answer. So I guess I'll start. Right, so a few words first about Expon Capital, just to put you into the atmosphere about what we're making. So what we do is we back exceptional founders, just those you see on the screen, founders of Spire. They're solving hard, valuable problems using digital technologies for a meaningful impact on the world. This is what we do. So what this means in terms of impacting the world is we look at global challenges as opportunities to create some value and change the world at the same time. So what you see on the screen are a few of the United Nations Sustainable Development Goals. There are 16 of them. You may know them. And we think that they together represent actually very substantial opportunities. We're talking about trillions of euros that will be created over the next decades in those different sectors and opportunities. This is a snapshot of the portfolio that we have assembled over the last 3 years. We're proud, we're kind of happy about these companies. They are based from Europe to the US and Israel, and hopefully you will see that they are having a very positive impact on the planet. Maybe tomorrow with my partner Rodrigo or Alain, 2 days from now, they will address one or more of these companies and what they're doing. So one of them is Spire, as indicated before. What it is, it's a satellite constellation of over 100 satellites. They're actually a data company. They're not a satellite company, but in order to get the data, they needed to launch satellites in orbit. And the objective of the firm is to predict weather in a much more precise way than what we're doing today, which is still pretty primitive. And ultimately, it is to save lives and to save food and to save people from destruction. So a revolution in the making. Today, just to give you an idea of what they're doing, they're already more than 2 days ahead of the most advanced weather systems on the planet. Another one is based in the US called Catalyte, led by CEO Jake Chu. Jake has been working together with his teammates on the development of an algorithm that allows the company to predict that some people that doing the test will be able to become great software developers. And so the people that this company hires and trains are actually coming from underprivileged background. They're people of color, which actually mimic much better than traditional development teams the population in which they are active. So then the company is based in the US. Extremely successful company. So that gives you an idea of hopefully a small flavor of what is it that we do at Expand Capital. Our agenda for today, so we'll go to the foundations of what makes venture capital, how it works, going through things like the return probability distribution, portfolio diversification, the types of strategies, and then very importantly, we'll try to make sure that you understand the fund economics, how it works, how do you make money in venture. Very few people actually understand that aside from, of course, VCs. And we believe that the greater the number of people understand what makes VC work will help the greater ecosystem have a better appreciation for what is it that we do. So first and foremost, let's start with return probability distribution. So to give a bit of context, let's say you invest €1 million in a startup. So my question would be to you, what is the probability that you lose 100% of your money? What's the probability you make your money back? So 1x. What is the probability that you double your money? 2x. What's the probability that you triple your money? And so on and so forth, right? So make a mental picture of what this probability distribution looks like, right? So you probably, some of you may have an idea of what it looks like. Some of you may have never thought about this, but actually it is important to have an idea of what it looks like. So everybody knows, I guess, the Gauss curve, that is also called a normal distribution, which you see on the screen now. And VC does not follow a normal distribution. So a normal distribution is, for instance, things like IQ, for instance, intelligence. There's roughly a great proportion of the population is between 70 and 110, let's say, with I guess the median should be around 85, something like that. And there's very few very idiotic people and very few extremely smart genius people. So that VC does not follow a distribution like that, where there's very few losses and a lot of very average outcomes and very few outsized returns. The next question is that in terms of this distribution, why you probably won't invest in the next unicorn if you try to invest in VC. And the reason is what is called the power law distribution. And if you look at this chart, just a little caveat here, this is a mathematical representation of the power law. Of course, it takes some basic assumptions. So you may have different, let's say, specific depictions of this distribution curve. So here you see the probability goes from 0 to 14%. And actually on the same screen, you could have 0 to 50% and the return could be not stopping at 10x, but could be at 100x. So but overall, the point of this chart is to show you what the Power law is and what it means. So specifically, if you look at the probability is that there is a, let's say, a lower than 2% probability of doing 1x. And there's a fraction of 1% probability to do 4x, 10x, and even 100x, if you can imagine it's extremely close to the x-axis. So what it means is there's that most investments in venture capital are actually not going to return 1x. And in extremely rare cases, you're going to have some outsized return above 10x, all right? So that's what this curve is saying. In other words, well, there's two elements to the Power law. Is it's actually what it does, it increases, you see that on the screen, it increases the amount of the probability distribution that you don't get your money back, right? So here in this case, you actually don't get your money back in more than 99% of the case, which is a little bit too extreme. On the other hand, you will probably have a bit too high a representation of extremely high multiples. In reality, it's not as extreme as that. So on this screen, you see two things. This would the distribution of exits by size. So according to two segments, in the enterprise segment and the consumer, both of each do account for 100%. So what this means is most exits made in VC occur both in enterprise and consumer below $50 million, right? And actually, we're talking about even 60% below $100 million. So what this means is the right assumption to make when you invest in a startup is that if you end up making some money, which we have seen is the extremely rare occasions, you're not even going to be making a lot of money. The odds are that you're going to be making a very small amount of money upon exit. And on the right-hand side, you see that there are between 6.9 and 7% of the cases of the exits where the exits are over 1 billion. So you see it's a little bit skewed on the right-hand side because some of the firms, when they are growing extremely fast, they get supported by the very best VCs and they are turned and they're actually manufactured into successes. What we have been seeing over the last 20 years and specifically over the last 10 years is that so over 60% of the industry returns on average came from investments that were outside of the 10 largest outcomes. So if I come back to this screen here, what it means is that you have the tail, and the tail is outside of the big outcomes. The big outcomes are the one on the right-hand side, where you have, the 7% of the deals over 1 million. So that's actually, if we were to not show you the percentage of the number of exits, but rather the amounts, it would actually show on a totally inverted curve, where most of the money would be on the right, and you would have the tail would be going in the opposite direction. I hope it's clear. We're going to come to that in a second anyway. So the tail is been growing. What it means is there's an increasing number of transactions that are, as a whole, happening between 0 and 1 billion, right? So in other words, there's an increased level of M&A and, well, actually exits, M&A and IPO taken together that have been occurring over the last 10 to 20 years. Now, if we look at, so this is the same curve, but in log normal, we see that there's actually a slightly improved death rate compared to the power law distribution that I showed you above, where on the right-hand side, you see there's actually for 1x, you see that you have a 4% probability of doing 1x, and you still have a fraction of 1% doing 10x. It's a slightly improved, let's say, representation of what the power law probably looks like in reality. So I took here a quote from Mark Andreessen. Mark Andreessen is the founding partner of Andreessen Horowitz. He's also the founding CEO of Netscape, which was one of the first browser on the internet back in the 90s. And what Mark Andreessen, when he founded Andreessen, he said something like this. It's that there are about 4,000 startups a year that are founded in the US tech industry every year, and that would like to raise venture capital. And Andreessen can invest in about 20, right, per year. And they see about 3,000 inbound referred opportunities per year. They are going actually to qualify only a couple of hundred of them, and they're going to invest in only 15 of those. And 15 of those in general will generate 95% of all the economic returns. And of course, Andreessen would like to invest in these 15, but they will probably not even invest in those 15. Then out of the 20 in which they invest every year, they will probably invest in 5 of those 15 that generate all of the returns. And half of the other, not half, but more than half of the investment that they make, they end up losing money. So this is, by the way, what this power law is showing is that in most cases, it can be more than 50%. It can be even more than 80% of the cases, VCs actually will end up losing money. So I don't know if it's clear. If there are questions at this stage, don't hesitate to interrupt me. So the first key takeaway out of this is that there's a lot of opportunities around the world. If we look at not only in the US, but roughly all around the world, and not only in technology, but across all different types of sectors, there's probably around 100,000 new startup opportunities every year. And some of them are extremely, let's say, uninteresting. Most of them are uninteresting, but some of them are actually, let's say, borderline. The fact is that even out of, let's say, maybe the 4,000 that may be look professional, only about 100 will probably end up outperforming, and outperforming meaning generating returns to the tune of 20, 40, 50x or more. So the big question you should be asking yourself is, can anyone and everyone be successful in venture capital, knowing that the odds are stacked against you since the very beginning? What we believe is that because of these odds, venture capital investment requires access. You need to be able to access the right deals, and you need skills. So this is not, let's say, something that you can do and just invent and say, hey, well, I'm going to be a VC. It takes probably a decade or more to become a good investor in venture capital. It takes a lot of failures more than successes to actually understand the process that I'm going to talk about today in terms of the portfolio construction, but also what Rodrigo will tell you tomorrow about what the criteria are. So what the power law says is that roughly 2.5% of all venture deals generate 100% of the industry capital gains. That means that 97.5% end up generating nothing, zilch. To give you a flavor of what this means, when Facebook IPO'd, so that was quite many years ago now, what, 8 years ago or something like that, the capital gain that venture capital firms realized upon exit of Facebook were greater than all of the combined capital gains accumulated by the venture capital industry since the beginning of the venture capital industry. All right? So the capital gains in Facebook accounted for more than all of the capital gains of the whole venture capital industry forever before. So that sort of gives you a really good picture that venture capital is about very, very big winners, very big outcomes. All right. So what does this mean for portfolio strategy? Now you know that there's a power law distribution of returns. And so what do you do in terms of portfolio construction when you know that there is a power law? Before I move to the next section, any question on this part? Stéphane, Evie? No?
All good on our side.
All good. Thank you. So let's move to VC portfolio diversification now. So a small refresher first. Why diversify? I guess all of you know, so it's going to be really fast. Well, people diversify because they want to reduce risk while keeping the same level of expected return. So that's it in a nutshell. You want to take less risks while aiming for the same type of expected return. So what do we diversify? Well, we can't diversify the systematic risk. That's just impossible, strictly impossible, but we can diversify the unsystematic risk, such as, you know, whether we're investing early or late stage, in specific industries, like, you know, you invest in travel, if you end up investing in other sectors as well, and you're being hit by a virus, of course, you're happy that you have invested in other things than travel, even if you may have a travel investment in your portfolio. Domestic versus international, of course, a virus can hit a particular region. SARS hit only Southeast Asia and then hit the rest of the world. So there are these different elements that, let's say, are going to contribute to the diversification of the risk. So why does it matter in VC? Well, let's connect this to the power law distribution, which I just explained. And the point is that because there is such, the odds are stacked against you, because there's such a small probability that you hit a home run, means that you have to play a lot, right? So if you're playing Lotto once in your lifetime, the odds that you're going to win are extremely small. But if you play, I don't know, 1,000 bulletins every single day, you're increasing the odds. Roughly speaking, it's the same thing in venture, and you have to place enough bets. You increase the probability of winning, right? So this is another probability distribution curve. Again, I have to tell you, there are some basic assumptions underlying this, which may, if changed, alter the shape of the, not the shape of the curve, but the numbers. The numbers may look a little bit better. So this is the minimum type of multiple distribution according to the portfolio size. So what it says is basically if you want to do 2x on your portfolio, you need 50 companies. 50 companies, and you can do 2x. That's the minimum size of the portfolio. If you want to do 2.2x, you need about 100 companies in your portfolio. So this curve here is a little bit extreme. In reality, most VCs end up constructing portfolios around 25 to 35, so 30 on average companies in a portfolio. That is, of course, an average, as I said. Each VC is going to be different. We're going to talk about that in a minute. The point is, you need to have sufficient exposure to a certain number of companies. Just like if you remember the capital asset pricing model of Markowitz, we're talking about at least 12 stocks in your portfolio in order to, reduce the unsystematic risk. It's the same sort of thinking and underlying mathematics that is shown here. The next question is of course, you need to diversify. You understand the reasons why you need to diversify, but is too much diversification a bad thing? And we argue that actually too much diversification is a bad thing. In venture, there are very few investors that end up having 200, 300 participations in their portfolio. Just like you have UCITS investment managers that end up having those kinds of portfolios with 100, 200, 300 shares in the portfolio. It's not uncommon. In venture, it is, because each investment actually is not made through a computer and you buy the stocks through a broker. It's very easy, very straightforward. There's a lot of information available. In our case, of course, each investments require a lot of time to do due diligence. You need to understand the people. You need to meet the team many, many times. You need to create a relationship. And of course, the more relationships you need to maintain, the less time you have, and the less the quality of the worse the quality of the relationship is. So there is a tension, of course, here, as you can imagine, between the number of companies that you can invest in and then keeping, let's say, the risk in check. And when I say the risk is, of course, the closer you are to the entrepreneurs, the more information you have, the lower the risk, right? We believe that venture capital is actually a very low risk business because of the fact that we spend so much time understanding the business of the entrepreneurs, understanding the market and the dynamics and the client's needs. So that reduces tremendously the risk, but that can only be done with a very limited number of companies that you're working with. And of course, the more businesses in which you invest, the less time you can add value. And we're in a business that we, as much as we can, we try to support them and add some value. And this requires, of course, that you have enough time. The last point is that our funds, they're limited in size. We don't have unlimited amounts of money. We raise a certain amount of money and we have to deal with that amount of money. And with that amount of money, we need to be able to choose how we allocate the money between the portfolio companies. So if you have too many, you don't know what is going on in them, and you are not going to take the best decisions on the allocation of the money. And allocation of the money where it's going to multiply the best. So again, there's this tension between diversification and, on the other hand, too much diversification. Any question? Yes. I heard the mic. All right.
I think, Jerome, everything seems quite clear. Please.
Thank you. All right, now let's move to the VC strategies. So let's look at the bottom of the screen here. And let's look at what we call the venture capital continuum. So the financing continuum. We start on the left-hand side with the pre-seed. So you have a founder, has an idea, and is going to go to the bank and invest her savings in the company, ask for friends, for family to help, is going to be probably incubated these days or go to an accelerator to, get some advice from coaches. And with that money is going to develop the concept and go as far as possible. Typically, that's going to happen with a very small amount of money. Typically about 100,000 or even less, sometimes a few €100,000. And the next step is the seed or pre-seed. These days, all these concepts are a little bit blurry, where the founder or founders are developing a team around them. They want to develop the prototype, the minimum viable product maybe at this point. They're going to ask for angels to invest. They're going to approach some seed funds that do some micro seed or some seed. Here in this case, we may see the first semi-institutional investor with seed investment funds, or pre-seed as we call them these days, investing typically up to €1 million. The next step is where things are getting a little bit serious. It's the second seed or pre-series A, where you have the MVP, the minimum viable product. So the product works, you want to test it, you're having your first customers, maybe 500 beta testers, you have a community of testers to make sure the product fits the needs of the market. But you haven't really tested whether people are ready to pay for it, or you have only a few tests that you've done, and some people have indicated they're ready to pay this, another set of people are ready to pay that. So you're really exploring what you can do with your product, and the product is not finished. And then the Series A is where things become really more serious. You get the funding. It may start even at 3 million, can go to 15, sometimes even 20 million euros. You always have venture funds at this stage that are going to be active there. And the goal of the Series A is to prove the product market fit. So it's to prove that you have a product that people want, they're ready to pay a certain price for it. The cost of distributing the product is going to be known by the end of the Series A, and you will be able to prove that you have a recipe that you can replicate and scale in order to get to the Series B closing. And the Series B is really you have the recipe that you discovered in the Series A. You have this recipe with a certain product, a certain price for a certain target market. And you know how to distribute it with a sales force, or maybe only online, self-service. So you know how to produce, deliver, maintain, and grow your customer base. And you need to really push the accelerator in order to go from, maybe 100,000 users to 10 million users. And that's what the Series B money is for. And Series C is just a continuation of that, but even with the added component that you may now start to think about making some money at some point. So that's, broadly speaking, the venture capital continuum. And what the strategies are, it's about initially thinking, okay, where as a venture capital fund, where am I going to focus? You know, am I going to focus on seed, on pre-Series A and Series A, or on Series B or Series C? And what we see in practice in the market is that you have early stage funds that are going to do, you know, seed. They're going to be seed only funds, making small tickets. They're typically small size funds. They're going to take, you know, 10, 20% of a company, investing maybe, you know, 400, 500,000 euros. And then it goes all the way to Series C, you know, with each fund having a specific focus. In the market, we don't see very much funds that are dedicated only to, you know, things like Series A or Series B. It's a little bit more open than that. You have seed funds that really are pure seed funds, but then you have a lot of funds that are doing seed to all the way to Series A, for instance. And then you have the ones that are doing Series A all the way to Series C. And then you have some growth stage funds. So you have these multi-stage funds. You have early stage funds and you have late stage funds as well. There's not many pure late stage funds in Europe. There are pure late stage funds in the US. We believe that there will be pure late stage funds in Europe as well, more than there are today. There's probably 4 or 5 in Europe today. I'm going to come back to these concepts again in the next slide. So there's also 2 different types of approaches. One, those VCs that call themselves generalists and those that call themselves specialists. It's really 2 different mindsets. The specialists, it's quite easy to imagine who they are. They're a French fund. They're focusing on agriculture, and they're focusing on, let's say, seed stage in agriculture, right, in France. What this means is that you're never going to see them in Germany, you're never going to see them in the UK, and you're never going to see them competing for you on a fintech deal, right? And then you have the generalists. The generalists, they are much more open, of course. They can be geographically focused on one country, like the UK, for instance. So they would invest in all sectors in the UK, but they would be generalist in that context. That is, the majority of funds are generalists and not specialists. And the reason is that LPs will want to reinvest in a fund or invest in a fund where there is some continuity in the thesis, right? You buy a brand of a car, and because the car conveys some values to you, of, you know, I don't know, comfort or sportsmanship or, you know, or quality, you know. And here it's with VC, it's the same thing. You're getting exposure to a certain flavor in terms of risk return, portfolio target, and you want to keep it that way. Also, the reason is if you invest in a second fund or third fund or fourth fund, the VC has basically built a certain track record using a certain recipe. And when you have a specialist that is going after a very narrow industry, that industry may actually not continue and be only a flavor of the day. An example is, we know of a fund that was dedicated to robotics many years ago. They raised the fund. It ended up being relatively small, and there was not enough deal flow. And there was some issues with paying the partners so that they could, you know, have a decent life. And so the GP was actually dismantled, and the fund had to be sold to another management company. So there is really an issue with specialization in terms of the sustainability of the theme over time. With fintech, we may wonder whether this will remain a sustainable theme over more than a decade. It's a good question. So to go still deeper in terms of the different types of venture capital strategies, well, we talked about the development stage, some focused on early and late stage. An example is Index Ventures. Index has a late stage fund, but they also have a generalist fund that invests from early to late. In terms of sector, you have the focus fund, for instance. Point 9 is very famous in Germany, but they invest throughout Europe and beyond in SaaS. Blackfin invests in fintech. So very specific on a sector. There are some advantages for these funds to focus because they make a name for themselves in an industry. If you compare with Expand Capital, for instance, we receive opportunities across all sectors because we're agnostic. What this means is we don't have a big name in fintech, or we don't have a big name in SaaS, as opposed to these guys like Point 9 or Blackfin. However, in the long run, we will be known as generalists. In terms of geography, I explained to you, being focused on a specific country. First Momentum, for instance, is first seed funds focused on Germany. When you do seed, early seed, that's pre-seed or the really beginning, you're writing checks of 200,000, 300,000 euros. You really need to be very, very close to the ecosystem. You need to be very close to the founders when they have the idea that to create their company. It's impossible if you're in Luxembourg to do some pre-seed in Poland, for instance. You're just too far from the market. So what this means is, for instance, for First Momentum, they are only active in Germany and not even in the whole of Germany. Impact funds as well. There's an example is ETF Partners based in London. They're an ESG fund, and they also respect the principle of responsible investments. So this is the case for us as well at Expon, and we believe this will be a growing trend in the future. So as you can imagine, there can be a mix between focus on a certain development stage, certain sectors, geographies, and impact. So it's not like you're in one area only, and you can have a strategy that actually picks some or all of the elements that are on the slide. So you form your unique strategy as a VC. And the last one is of course, corporate VCs, which are launched by big corporate investors. One example here is Intel Capital. They have been there for more than 20 years. And they are one of the most astute financial investors among the corporates, even if they end up in the end do strategic moves. So most corporate investors actually have a strategic approach. And over time, this has proven to be relatively complex to maintain. And so Intel Capital is really here doing what we think is really the best approach is, that what you have to do is make money. And if you end up being able to use it for your strategic advantage, then you end up doing that. But you're going to invest pari passu with the VCs, and you're not going to take, let's say, you're not going to take some undue benefits that other investors don't have. You're going to be treated at the same level than the other investors. Now, in terms of portfolio allocation, there's different ways of allocating the money. There are some VCs in the market that do deal by deal. So they have a Rolodex of investors. They don't raise a fund. And whenever they have an opportunity, they will send you an email. And it will tell you, hey, look, we have this opportunity. Why don't you look at it and tell us whether you're interested? This is extremely flexible for the LPs, of course, but actually it may require quite some work because the LP is still going to be required to look at each and every deal. So it requires resources. Let's say there is some intensity to it. On the other hand, for the VC that has this approach, it's complicated to maintain a team because you don't have any guaranteed income to pay for the team and the due diligence for each investment and the scouting for deals, which is extremely expensive, which of course works in a fund context. The second type of approach is what I call the focused or the Peter Thiel approach, which they use at Founders Fund. They typically are going to have to invest in something like 5 to 8 deals, so extremely narrow. And the reason is that he says there's probably not more than 5 deals every year in the world that deserve an investment from a venture capital firm. So pretty extreme view here. Then you have the balanced portfolio approach, which I told you about earlier, where you end up between 20 and 35 focus deals, where that is built over a period of 5 years. So you see you're going to do something like 4 to 7 deals per year. And so you have a sufficient size of portfolio, giving you a sufficient exposure to the probability of hitting those very rare unicorns. Then you have the shotgun approach, also called spray and pray, where the VC is going to invest in a just much higher number of investments, and we're talking, easily up to 50 investments, sometimes even a little bit more. And the last one, which is in the same sort of context, which is really the statistical approach to it, with mini bets, which can be several hundred bets, which are deployed over a period of 3 to 5 years. You have several investors doing that, like 500 startups, Seedcamp or Kima, are having this approach. We believe that it's a very interesting approach, but it's very complex to maintain for the reasons that we explained before. It's much more process-driven than conviction-based driven. What I mean by that is when you look at the balanced portfolio approach, we use the term focused because it's conviction-driven. Really think about what the future of an industry or a market can become over the next decade. And we developed this conviction. When you have the statistical approach, you don't have a conviction and you don't have time to build a conviction because you have all these deals that you need to make. If you make 100 deals a year, you're doing what, 2 deals per week. And when you're on a holiday, so it's probably more than, at least 3 deals per week. And if you've done any deal, a VC deal in the past, you know that it takes a lot of time to do a deal because you have a lot of documentation. You need to go through all the documentation. You need to sign. You need to, follow all of the process. I'm not even talking about the due diligence and the work that is involved. So what it means is you don't have time to think about the quality of the investment. You really are an organization that is producing investments, producing deals. So very, very different dynamics that may or may not work. We believe it's obviously a lot more risky in a way because of the fact that you cannot easily identify the ones that are performing, and so in order to overallocate in those, because you don't have enough time to dedicate to maintaining a portfolio of, maybe in a first fund you end up with 300 companies, but by the second fund you have 600 companies in the portfolio. So the numbers of it just make it very, let's say, inappropriate and not very comfortable. The strategy can be to be a hands-on operator or a hands-off networker. Two very different approaches. There are some cliches, of course, that the operators tend to be former entrepreneurs, so they know how to operate a company, and they will be very deeply connected with the CEO and help the CEO on a daily basis, almost, or a weekly basis, helping transfer some of the skills that have been honed over many years or decades. And then you have the hands-off or the networker style management, where you're going just to make some introductions, help with business development, help with hiring, just by making introductions. There's really a mix between the two. I think that in the past it was more, this was an industry that was more skewed towards networkers than operators. And I think this has changed a lot over the last 10 years. A lot more entrepreneurs have entered the venture capital space. And so you have really, big mix between the two. I won't comment on which is better than the other. I think they're very, very different styles. Then there's this issue of, established versus emerging VCs. It's not really related to the venture capital strategy within a GP, but more from an LP perspective. I thought this was relevant. And when we look at the outcomes, what we see is that there's a majority of the value creation in venture has come from new and emerging managers. And what this means, conversely, is that established funds generate actually a minority of the industry performance. However, those established managers are able to deliver superior performance on a consistent basis. That's why you have, the Accels, the indexes, or the Mangroves of this world, because they have proven over decades that they can return the money. And conversely, we see that sometimes the second fund are doing better, or sometimes the third fund is even doing better. This is the case of DN Capital, because the partners have learned some very valuable lessons during the first fund, and maybe the first fund was launched at a very bad time, where then they ended up paying much more. What is quite relevant for both the GP and the LP is the size of the fund. And here, what you can see on the screen is the performance of the funds and recent reports since the beginning. And you can see that the first fund was 300 million, and the last fund almost 2 billion. And the bigger the fund, the lower the performance. And it's very easy to understand. It's the more you have to deploy, well, the less you're demanding in terms of the type of quality and return that you expect. It's very hard to deploy money that can generate 20x or 50x or 100x. The number of opportunities is not growing at the same speed as the amount of money going into venture capital. So smaller size funds, below 500 million have better track record and probability of multiplying the money versus funds which are much higher than that. So timing, does timing matter? Timing matters a lot, but Having said that, you can't time the market, VCs can't time the market, and LPs can't time the market. And they shouldn't, neither should. That's why it's the best advice for LPs is to just have a strategy and keep it for the long term, invest in venture, and every year invest in new venture funds and have a program. Same thing for private equity funds, is the same thing. The reason is you don't know, which vintage is going to be the best. It's just impossible to predict. And this is what Nick Murray has been saying for stock markets. It's just the same thing. So the best thing to do is just be in the market. Quite clear. So the key takeaways here in this section is there's really a great variety of strategies. There's several thousand VCs on the planet, and each of them is different from one another. There's not a single VC that is similar to the next one. There's two different types of perspectives on the strategy. There's some strategies that are right for some, and some are just not the right for some LPs. That's why LPs need to meet many GPs so they can actually choose and get to pick the ones that they want to work with. What's the right investment strategy? Well, the point is there's probably not a right or wrong investment strategy. It's always the execution that matters, and the consistency of the strategy with what was described before with the parallel distribution. If you have something that runs against this concept of parallel distribution, there's probably something odd. How does strategy affect risk return? Well, again, we addressed it, and hopefully this was a good and interesting section for you. Younger funds can deliver superior performance, but established players have been able to consistently deliver performance. So for LPs, it's good to have a mix between the two. Small funds tend to perform better than very large ones. So that's a big takeaway as well. So when going with established players, it's always better to go with smaller funds than bigger ones. And then timing is just impossible to predict. Any question before we delve into the venture capital fund economics? Do we have a lot of shy people today, or what?
Dear participants, you're more than welcome to ask your questions.
Perhaps I can ask a question, or if it is too early, let me know. You said before that you cannot employ a lot of people due to the fact that you don't know what the later income is. So how do you organize the due diligence and all that lot of paperwork you have to do? Do you outsource that, or?
Okay, so this was only related to the deal by deal approach, right?
Okay. Mm-hmm.
Only, so in the deal by deal approach, there is no fund, which means there is management fee, unless you have a contract to make an investment, and then you're going to have a management fee dedicated to that special deal, right? So okay. In all other cases, you have a fund and you're charging for the fund. But it's a very good question, because we're going to get to this in the whole section that is coming now.
Oh, cool. Okay, thanks.
Any other question? If there isn't, then let's go into the venture capital fund economics. So I think this is the really, after the understanding the parallel, this is really the core of today's section. So I hope you can stay focused, because we'll do a lot of mental gymnastics together. Don't be afraid. I try not to go too fast. So here are a few key parameters. Don't be afraid of it. It's just, we're going to come back again with the to this. But so the point is, a fund, a venture capital fund, is typically 10 years. And then you can have 1 year extensions. You can have 1, 2, typically year extensions, but you can even have more. I think that the EIF today, they have 23 or 24-year-old funds in their portfolio. So that were 10 years in the fund terms in the beginning. So you can see some funds are hard to die. Then you have the management fees. They're typically 2%. You can be 2.5 or even 3% in some cases per year. Can be calculated on commitments, but I won't go into the details here again. But typically, let's say it's on commitments. And the sort of rule of thumb is that the management fees over the time of the fund are not going to exceed 20% of the fund, all right? So what this means is 80% of the money is going to work, right? Because if 20% of the money goes to the management fee, there's 80% left, right? And so that 80% left is going to be invested in companies and startups. Now, the next concept is the hurdle rate. The hurdle rate, or it can be called, the discount rate, or the preferred return. Some people call it preferred return. Is in the US, in Israel, it's 0%, always 0%. In Europe, people probably in institutionals don't yet get it, but it's against their interest to have a hurdle rate that is higher than 0%, but still they insist. And so they have this preferred return, which means that VCs end up taking less risk than in the US. And as you have seen before in the parallel distribution, actually VC works only if you take maximum risk. So the hurdle rate can go up to 4% sometimes per year. And so this means that that we have to, the VC has to pay back at least 1 time the fund, but it can be up to 1.5 times the fund to be paid in priority to the investors. Why 1.5? Because if you do 4% a year over a period of let's say 6 or 7 years, you're going to end up with a preferred return of 0.5 on top of the 1x that you have to pay back. So you have to pay back 1.5 times the fund that has been drawn from the investors. Then comes the concept of carried interest. That is the performance fee that is paid to VCs for delivering the performance. And this comes, of course, only after the preferred return has been paid. So if we take all of this together, all these concepts, in order to have zero carry, so to get to let's say break even for a VC, we need to multiply a fund by around 2.5 times. And only if we do more than that, we're gonna get paid some carry, right? And so that's on average. Sometimes it's lower, sometimes it's higher. It depends on the hurdle rate, depends on the speed of deployment and many other things. So what this means is we will, as VCs, will always target multiples of at least 10x when we invest in a startup, right? We want to do at least 10 times our money, sometimes a lot more, right? So this is, again, it's a rule of thumb. Now let's show.
Jérôme,
yes?
Jérôme, if I may interrupt you, it's a great presentation and it's very clear. That's why you have not many questions. But I don't understand the hurdle rate and how you discussed that in America it's different, in Europe it's different. Can you just maybe I just didn't quite catch it, but could you again, as an investor, I'd like to understand what is the difference between the European market and the American market.
Right.
How this hurdle rate is not working here and it's working there, or do I understand it correctly?
So it's quite straightforward, actually. It's so in the US there is never a hurdle rate, or in Israel venture capital funds there's never a hurdle rate, which means that the carry has to be paid immediately when 100% of the fund is being paid back to limited partners. Right?
Yeah, that makes sense.
There is no preferred return other than let's say, paying back the money that has been invested.
Okay.
And in Europe, investors insist on a hurdle rate to get a preferred return. They want to be sure that they're going to get some guaranteed return.
The reason that's perhaps of the historic
yes,
interest rates related mentality.
Yes, it's related, I think, to the conservativeness of the culture compared to the Anglo-Saxon culture and the understanding of the mathematics and the power law. If you understand the power law, you understand that the hurdle rate should be 0. If you don't get it, well, you're going to insist on the hurdle rate, but then in the end, you're going to end up probably with a lower performance because the fact of the VCs are going to take less risk because they have to pay a guaranteed return. I think it makes sense.
Thank you so much. Thank you. This makes it clear.
You're welcome. So a little case study here with Inside Venture Partners. This is a real fund that was launched by this US venture firm based in New York, a very big venture firm. They're active in late stage growth. This is a 2007 vintage. The term was in 2017. They raised $1.25 billion for this fund. The management fees were 2% per annum. So during and after the investment period, right? So that means that 2% over 1.25, that's $250 million, right? So what this means is the investable amount before recycling, and I explain recycling in a moment. So the investment amount is 1 billion. Why? Well, you have a fund where LPs have committed 1.25 billion, and then you take out the management fees, it means you can invest 1 billion. Very straightforward, right? The 250 million, they're going into the pocket of the VC so that they can pay the salaries and the traveling and the analysis, et cetera, et cetera, et cetera. So there's 1 billion that's going to be invested. Now there's recycling. Recycling, that means when that Inside Venture Partners invests in companies and within the first 5 years, they sell a company and they make a profit, they can tell the LPs, we're going to keep the money, or we're going to label it as recallable so that we can reinvest it. And that's called recycling. And here in this case, recycling was 120% of commitments. Commitments was 1.25 billion. So 120% is 1.5 billion, okay? So it means that the that could be recycled is 500 million. So and that is the difference between 1.5 and the billion that is investable. All right. I hope I didn't lose you there. Again, it's quite straightforward. So it means that Inside Venture Partners, I don't remember what the fund, it was 6 or 7, whatever. They could generate exits within the first 5 years up to 500 million, and they would be able to reinvest it. So that's the basic data. And the hurdle rate is 0%, as indicated. It's a US fund, so it's normal at 0%. Now, what happened in reality is that the fund manager, they make capital calls for 1.34 billion. So that's the 1 billion that they could invest, plus 340 because that there was some recycling, because they made some sales within the first 5 years and they redeployed 340 on top of that. And by the end of that was back in 2017, I think, when the data is based, they had received 2.121 billion in proceeds. But they had not yet liquidated the portfolio because there were a number of companies still in the portfolio. And so the cash out plus the remaining value in the portfolio was 3.15 billion. So that means that the multiple at the 30th of June 2015, which is the date where I got the data at, was 2.5, right? And the IRR was 20%. So not bad at all. And so if we calculate the carry distribution, we end up at, so the cash out at that time, minus the amount of the fund that has been drawn, multiplied by 20%, and you got 174 million. And that's before the end, of course, because there's still 1 billion that's still in the portfolio, right? So the carry will probably be much higher than that. And it, by the way, was not yet liquidated in 2018. So you see, these are the, let's say, the basic dynamics at work. So now let's get deeper than this. Let's imagine that we're deploying a fund of 120 million euros, right? So it's a European venture fund, and it's a balanced strategy. They are going to invest, if we look at the first line, at the right-hand side, 29 initial investments. So they have, this GP has invested in, will invest, I'm sorry, it's in the future. They will invest in 29 companies over a period of 4 years, from 2020 to 2023. And we can even see that they invest 5 years in 2020, 10 years in 2021, 8 in 2022, and so on. All right, so the next line below initial investment is the follow-ons. The follow-ons is when you, the VC, invest in an existing portfolio company. So for instance, in 2020, they invested in the months of January in a company, and by the end of the year, they were going to reinvest some money in a company that they invested in January, right? Same thing in 2021, they invest in 10 companies, but they will reinvest in one of the 10 companies they have in the portfolio. And then in 2022, they will reinvest in 4 companies they have in the portfolio. And you see that actually the follow-ons, they keep on happening until 2027. So the initial investment period in this case was probably 4 years, or maybe 5, but they had, you know, they closed earlier because they were done with the investment, the deployment of the investment portfolio. But then the follow-on period stays for 4 years after. So it's always important for a VC to keep some dry powder so that they can support the investments in the companies that they invest. On the next slide, we can see the number of dead investments. And they come here in this case quite after 3 years. There's one dead, and then you have more dead over time. This may not represent reality, by the way. Debt portfolio companies don't necessarily take that long time, but it's just a model. And then the exits, on the other hand, they come starting in 2025, which is probably relatively, let's say, standard in peak cycles, such as we've seen in the last 2 years. You had portfolios being exited maybe after 2 or 3 years sometimes. This is rather exceptional. Typically in seed stage, it takes 8 to 10 years to exit a company. So that's quite normal for it to take time. So you can see the last line, number of companies in portfolio, they're growing, but they don't reach 29. In 2023, we reached 28. And why? Because there has been a dead in the same year, right? So we never are having a portfolio, the total number of companies. If there are exits or dead, those numbers reduce. So you can see on the next line, the annual investment amount, and you can see it goes up to 104 million. And the reason, of course, is because there has been management fees. So there's 20 million euros in management fees, which means that there's 96 million left to invest. It's written actually in the bullet points below. And then there's some recycling because there's been a sale. There's been a sale in 2025. And the money has been deployed in a follow-on. So there's actually 8 million has been invested in recycling. You can see the death rate here is there's 17 companies dead. So that's slightly more than 55%. The goal is always to have, very big outcomes. So there should be at least a unicorn in the portfolio. There should be some big blockbusters that generate a lot of performance. Yeah, one last thing I wanted to share with you is that in the industry, we say that a partner can do 3 to 4 deals maximum per year, right? So per partner. So in our case, we're 4 partners, so we could theoretically do up to 16 deals a year. We never do that, of course. The higher the number of deals, the higher the risk there is, of course, because you don't end up spending enough time to invest, to analyze, sorry. So in the end, what does it look like? So let's imagine so here, the end of the fund is 2029. So let's imagine we're in 2030. We're all 10 years older than we are today. So what happens? Okay, so we see that this manager invested in pre-Series A some money, in Series A, in Series B, in Series C, and Series D companies. And we can even see the amount of money that were invested in each series initially. We see the percentage of the fund size, the number of investments, and here we see that there were 23 investments in pre-Series A's and for a lot of money. So a lot of 47 million almost in follow-on in the pre-Series A that was invested. So I think that you don't necessarily need to go into the details. What I wanted to show you is more the lower half of the screen where what the dynamics is. So for 120 million fund, 80% of the money is put at work. Remember, there's 20% going to the management fee. That means that 86.6% in this case because of the recycling. Remember, there's 8 million euros has been invested in recycling. You can see that above in the table, recycling 7.9 million. That's the 6%, 6.6% on top. And 64% of the money at work is lost, right? So you can see there's a little arrow, and that's where you have 38% dead. So 19 companies were dead. So all that money, 39 million, is just gone in flames. And there's 26%, it's where you get a bit of your money back. You sell it between 0 and 1. Here to be just a very, let's say, to make a calculation, an easy calculation, let's assume it's 0. So 60%, 64% of the money at work has been lost. So what this means is there's 31% of the fund, of the 120, will actually be useful to multiply, right? So in order to return 2 times the money to LPs, remember this was a 240 million fund, it means that 37 million, because that's 31% of the fund, 37 million must become 240 million. That means that it must be multiplied by 6.5. That's a lot. Multiply that by 6.5. So this actually explains one very particular characteristic of venture. You heard it before probably, is that there is a great variance in the performance of venture capital. So, and the reason there is this variance is because of the fact that a lot of the money ends up being lost, and hence the money that is at work is going to produce the return. And thus there is a very big variability in the outcome. If VC was losing a lot less money, there would be a lot less variance in the industry. I'm not going to go into the details of that, but what I can tell you is at Expand Capital, we actually use the mathematics to our advantage, and we don't lose as much, so we don't have to multiply by such a higher number, and so that we can have a much lower variance probability for our portfolio. So we can actually provide better guarantees to our investors that they're going to be delivering some good performance without the variance. So now we know that this 37 million must become 240, that's 6.5x, but in practice, what does it mean? It's important to understand that. So remember that the fund will hold stakes of 5 to 20% of the companies at the time of the exit, right? So we invested, let's say, in company XYZ, and in company XYZ, we will have 15%, right? So the second point is, let's assume that the average stake, the average ownership stake in all companies is 15%, right? So we invested, what was it? What was the amount? Those 37 million, and we have 15% in, each of those companies that we have. And that's 15% needs to generate 240 million, right? That's what it means. But if we go one step further, point 3, it means the aggregate value of the companies sold. So all these startups that we invested in 37 million in, they must be worth 1.6 billion. Why? Because the 240 million is 15%. So if we look at 100%, what is it? It's 1.6 billion. So, but how many companies were to account for the 37 million? It's 6 companies. If we look at the portfolio, it's here above. You can see here, it's actually in these 2 slides. You will, I think, get them after the session. We have 6 companies. Actually, it's at the bottom. We can see it as well. 6 companies were sold. 3 of them just gave the money back with a small return. So let's say it's 35 million in total, right? 25 million. So we need, 240 minus 25, there's still 215 million missing. Now there's 3 exits left. They better be good. So one of them is going to do 4x. That's written here. We can see on the right-hand side, 2 to 5x, 1 for 4 million. 4 million times 4, 16 million. One of them is going to do 8x and is going to generate 80 million for the fund. And the biggest exit is going to deliver 12x and accounts for 120 million. That is a very good coincidence. That's what we call a fund returner, because the fund is 120 million, and that investment alone is paying back for the whole fund. But what it means is that the company, if we have 15% of the company, it means that he has been sold for 800 million euros. and most probably over 1 billion if our ownership percentage was below 10%. So it means that this company, this VC has really worked really well because they ended up picking that one company that is really an outlier in the power law distribution. So the conclusion of this section is that the fear, really what keeps VCs awake at night, is that they don't find and invest in that unicorn, this rare startup that will pay back the whole fund, right? So that's really where the anxiety comes from. Any question on this very important section?
I think, Jérôme, we had a question in the chat box.
Where is the chat box?
Just down next to the share screen button. So the question was, why do you calculate the carry on the capital calls, excluding recycling?
I can't see, wait. No, oops. I had to exit to see the chat. Why do you calculate the carry on the capital called excluding recycling? Yeah, well, the carry is not calculated. It doesn't include the recycling because the recycling is part of the money that was let's say just added to, that was deployed by using proceeds. So the carry is just calculated on the basis of the let's say the performance of the fund commitments at the maximum and money that is actually called in practice. So it's not, the recycle is not actually called money. It doesn't come from investors' pockets in a way. I hope it's clear. So I guess with time flies. There's a couple more. There's a few more slides, a couple more sections. I go through it now. So the VC co-investment for LPs. What are we talking about here? We're talking about a GPs or a venture capital firm offering to LPs the possibility to invest directly in deals. So this is what the EIF and EIB are doing. Actually, they're offering not offering, but they have a facility by which they allow the GPs to have the EIF co-invest alongside them. So you, as a GP, you invite the LP to invest directly through an SPV. We, as VCs, we always keep control of the SPV, and there's many reasons for that. One of them being that the fact that it just simplifies the corporate governance at the level of the investee company. The investee company, they already have a lot of investors that they need to manage. Imagine that if they had to manage even more, and you avoid having, let's say, conflicting agenda. You keep control of the agenda and there's no conflict of interest. It's typically the cost of running the SPV are split amongst the investors in the SPV. There is no management fee or a low management fee, sometimes up to 1%, and the carried interest is typically 20%. So that the economics are definitely in favor of the LPs because of the fact that there's no management fees. It's only the cost of accounting and tax. The benefits they're quite clear. You know, there's flexibilities for LPs. They can cherry pick and invest in specific opportunities that they like, and say no to others that they don't like. They have also more flexibility and control over the deployment of cash. sometimes they just don't have cash. Sometimes they have too much cash and they want to deploy it. So if there are opportunities coming when they have cash, it's great for them. They can put it at work. And there's, as indicated before, there's outperformance potential because it's less expensive than investing in a fund because you don't have the management fee. So the J curve is actually not a J curve. It's much flatter than a J curve. There's also great benefits in the GP-LP relationship. You get to work together closer. You get to strengthen the relationship. And for the LPs, they get access to pre-qualified deals, which they typically love. We at Expon, we really like to do co-investments because of these things and because of the relationship. And of course, we only do it for extremely high quality investments because of the impact it has for all of us. There are risks, of course. For an LP, it requires resources. I mean, it's not just a push button. You need to review the documentation. You need to review whether this is the right GP with which you're working and whether you have enough confidence. You have to be able to have the time to spend looking at the company itself. And even if you don't, then and you still want to go, you need time in order to close the documentation in time. I insist on that. And then you will have to monitor the investments as they mature because it's part of your accounting, your books. When you invest in an SPV, it's going to be in your books, so you're going to have to do some reporting. So of course you have higher investment concentration. So what you need to do as an LP there is you need to have a proper co-investment strategy where you are going to diversify again and have a portfolio of co-investments. There is a deal execution risk because there are possibilities that deals don't end up closing. And then you have breakup fees that you have to share as well, and that happens. And the last point is very important, is as much as you can actually strengthen the relationships between the GP and the LP, if the LP ends up not being diligent enough and fast enough in closing, then the GP can end up losing a transaction. And that would be a real mess. That would be really bad, let's say, outcome, because that would sour the relationship between the two. So only do it when you can actually be fast acting on those on the process. Yeah, the takeaways are quite obvious. We just went through it. Now I wanted to very briefly, over a couple of minutes, talk about the relationship between family offices and VCs. For me, the reason it's relevant is because family offices, we're talking about entrepreneurs, right? And entrepreneurs get entrepreneurs, and VCs, we are entrepreneurs, we work with entrepreneurs. So there is usually there is chemistry that comes quite quickly. Also, we figure that entrepreneur families tend to be very curious, much more so than institutional investors, and then they want to know what is going on, in terms of new technologies. They're extremely concerned about what is going on in the world and about the future. They care about the impact of technology. They care about sustainability, and venture capital is really at the heart of what is going on there. Also, what we've seen is there's been a hugely important growth in investments from family offices in venture over the last 5 years. We're talking about a five-fold increase in the past 5 years. So it's really very significant. So there's there's really two ways where we see that family offices and VCs are working together, either because family offices invest alongside us as direct investors, or indirectly through funds, so they invest in venture funds. We have a number of great family offices along our side, and as partners in our fund. We're very happy about that. They're really very supportive investors. As far as direct, we think it's really a question of resources, as indicated before. This is a real profession, right? It's not something that you can do between real estate, taking care of the yacht, and taking care of the bond portfolio. It's really this requires more than 100% of your time. So this is not something that all family offices can do, and it requires skills that have been honed over decades sometimes, in order to develop the know-how and the relationship and the access, as indicated in the parallel, the access to those deals that will make a difference. Ultimately, it's a question of critical size. In order to be able to create those portfolios, both direct and indirect. Even if you go to indirect, you still need to have several relationships, and critical size is absolutely important to get the appropriate exposure. Yeah, I think that with family offices, we're just natural partners sharing the journey. And the goals are very clearly shared between the parties. So that's it. That's it for me. Any questions?
So to ask any questions, you have to unmute yourself and potentially start the video. And Jerome, could you potentially give us more insights on the effects of COVID-19 on the VC sector for the moment? What is your view there?
So initially, I think it was very profound, just as for everyone, because it was just a shock. A lot of firms had a direct hit on the revenues. Sometimes, it was just a small hiccup of just a few percentage points of revenues, but sometimes it was dramatic, and we've seen decreases up to 100% of revenues for the period from mid-March to the first days of May. So very significant, but I think in venture, one of the things that the hallmarks of venture, and I'm not talking about us, but across the board in venture, is that we know these kinds of crises. We've been through that over the last decades, and we know that we need to act decisively and very rapidly in order to reduce the cash burn, extend the cash runway, because in times of uncertainty, the only thing that you need to do is preserve your finances in order to increase the probability of staying alive. So that's what we all did in the first weeks of this crisis. And then let's say uncertainty and visibility started to improve, and it's been very, let's say, different from one sector to another. Of course, travel has been impacted negatively. Remote working and things like that have been impacted positively, extremely positively. So across the board, there's been really a mix of let's say, of reactions. Overall, I would say in technology, it's been very positive because technology deals with digital, and digital is, let's say, made for remote. It's really the way of distributing a service or a solution that is the most resilient in this kind of period, right? In our portfolio, for instance, we have companies that have seen well, several hundred-fold increases in business over the last weeks. Yeah, I mean, very, very positive considering the situation. But overall, over the long run, what we have seen is very new trends that, I mean, not new trends, acceleration of existing trends in terms of, you know, the adoption of a number of these technologies, and that's across education, collaboration for enterprises, e-commerce, the way people consume, you know, food, even the way you source food and buy food online, which has been greatly accelerated. Very few people were doing that in the past, and now we've seen, you know, in one of our companies, 800% increase in the adoption of these technologies, and it continues to actually to increase these days. So yeah, very profound, long-lasting effects of this crisis, which is clearly not over.
Any last question before we close the session? Our course will be recorded and shared, no worries.
Yeah, don't be afraid, I love questions.
Hi, I've just got one. In this situation with the COVID-19, and you were talking about diversification in your portfolio, at this stage, what would you recommend to do if it were to these venture capitals at the moment? Do you sit and wait, or do you continue to wait, you know, weather the storm of the COVID and start looking at your portfolio, or you start doing something now?
Well, we are investing actually. I think that the speed of the industry has been slowed down a little bit. Like, you know, there's a bump in the road, and you just you slow down as you enter the village. And so the speed, I think, in the village is definitely a lower speed than on the highway. So I think that's, you just don't stop the car and you know, put it on the curb. You actually, you know, continue, albeit at maybe a lower pace than before. Remember, in venture capital, we're not investing, you know, in the stock market for the next week or 6 months. We are there for the long haul. We invest in, and the maturity of a seed investment is 7 to 8 years. In a crisis like this, you may even add 1 or 2 years. So it means that we invest with a very strong conviction for a very long period of time, right? So we invest beyond a crisis that may last even 2 years, right? So we think that a specific type of solution is the right response for a market need that will be huge, not in 6 months, but, you know, in the future, and will be a multi-billion euro market in 2025. So it doesn't really matter that, you know, there is this COVID now or there is not this COVID now. We believe that it makes sense.
Great. Dear Jérôme, thanks a lot for this insightful session on VC fund dynamics. Dear LPEA members, dear LPEA friends, it was a great pleasure to share with you this first session. The course was recorded, so no worries, and will be made available once edited. We will share more details concerning that part, and thanks again for your time and interest. We'll see each other tomorrow again at 1 p.m. This time we'll talk about the VC fund investing part. Thanks a lot, and if you have further questions, don't hesitate to write to the events@lpea.lu email address, and we'll take care of that. Have a nice afternoon and goodbye.
Thank you.